Test, test. This is the third time I'm making this video because the microphone was wrong both times. So, when I first started trading, I pretty much struggled for 4 straight years. And that was a really, really difficult time for me. That was one of the hardest things in the world, in my opinion. And I had so many questions trying to figure it out. And there was no way for me to really separate myself from retail to figuring out my own model, and there was no real guidance system. And that's what I want people to not have to go through. Something that they can avoid through that process is having a way to have your questions answered, have it answered properly, not with someone telling you that order blocks have to deal with a closure, because I still get onto calls with people and they're like, okay, close below the order block, when that's not when the change in the state occurs. And so all of these things, people have so many questions and really small details. And so that's what we posted onto Twitter. We posted a Q&A for your questions to get answered, and now here we are. And one of the first and most common questions I get all the time is, how often am I trading? And I'm trading, all depends on the chart. Everything depends on the chart for me. If we're inside of good price action, really low resistant runs, then I'm trading every single day that week, if it presents itself and my model presents itself. That's the key part. You cannot be a discretionary trader. Discretionary trading without a model leads to one thing, and it's going to blow your account because you have no consistency. Every single action that you're doing is not consistent with each other. So how do you expect to find consistency if your trading in itself is not consistent? There's no way to identify true errors inside of you or your model if every single time you're doing something different. That's why, and one of the main reasons why you have to follow a model. And when I'm following my model and it presents itself, I take it. But leading into the real answer to that question is, I'm trading probably 4 to 5 times a week. Rarely I'll trade 3. You guys know from my Twitter that we haven't had a losing day this month. The past 2 months we've had 3 losing days. So it really all just depends. And that leads us into the next question of, how do you know when not to trade? How can you identify bad trading conditions? When do you push and when do you not push? And that's, in my opinion, the most important thing that anyone can figure out, is when to not push. And you have the basic rule of thumbs: days after a large range day, you have large overnight expansion, small opening range gaps when the high time frame objectives are taken. All of these things, if London takes out Asia high and Asia low during London session, and there's no real high time frame bias, that New York session is going to be bad. So you have all of these specific situations, but the most important thing that someone can focus on inside of that is watching it. I see so many traders sit inside of that bad price action and they say, oh, I'm not watching this, I'm walking away. Well, how do you expect to mold patience? We're not born patient, and you shouldn't expect yourself to be, right? No, why would we want to wait for something? Why would we want delayed gratification? It's unrealistic to think that. So the only way to become patient is to mold it by sitting in those bad price runs, by watching high resistant liquidity, by looking at seek and destroy days, and really conditioning yourself to watching them. And when you watch them over and over and over and over again, what you're going to notice is you're going to see, okay, this is what that day looks like. That's what it looked like during the overnight session, during London, during pre-market, during New York. All of these things, all of these specific times that we're looking at, this is what happened during the macros. Can I find a scalp during the macro? Where did the macro go to? Did it create SMT? All of these questions, you're going to identify them, and you're going to say, okay, well, this is what bad conditions look like. And basically doing a reductio argument, you can identify, okay, well, by proving that, now I can contrarily know when good price runs are going to occur. So those good price runs, you're going to say, okay, well, this doesn't look like a bad price run. Or you're going to see the bad conditions and say, oh, well, I've seen this before. I know it's going to be bad conditions, which all goes back to backtesting. Are you going back and looking at only good price runs? You have to look at when your model fails, when your model doesn't work, why it doesn't work, what conditions it fails in, what's the daily profile, the intraday profile, the weekly profile. All these things are what I'm gauging when I'm going into my trades. And you saw the breakdown of my 2 trades this week, and those are the exact same things that I'm talking about inside of those trades. Second question is, do you have a model around first presented fair value gap? And yes, of course. But it's not just as simple as, okay, well, I have a model for first presented. I'm also using first presented as narrative. So let's say if I'm trading a Cairo and I have first presented down here and a 5-minute fair value gap up here, and we inverse that first presented, so that tells me order flow is bullish, and we traded down to it, and we stayed above 50%, the body's respected above it, and now we're rallying off higher. That narrative, leaving that bottom 50%, is showing me strength. So now when I go into my trade for Cairo inside of that 5-minute, I'm not worried about price trading all the way back down to first presented, to the first presented low, because one, if we were going to do that, we would have done it already, and two, we have relative equal highs above. So where is that price run going to reach for? That price run is going to reach for the buy side. And we're going to want to see measures of strength because we're expecting a low resistant liquidity run. So what do we look for? We look for the Cairo with strength, forming a narrative, looking at the order flow below us and to the left of the chart, and that creates a high probability trading condition for us. Or if first presented is left as a breakaway gap, then that shows me even better strength. So it's not just, okay, well, obviously, if we're using Cairo and first presented fair value gap is shown to be the inversion for Cairo, then yeah, that's great. That's super high probability. But it's not just a 1, 2, 3 pattern trade. It's I'm looking at everything inside of the chart to make a very specific framework and identification to be confident in the trade going forward. And when I have that, I can confidently hold my position. If I'm in a position, I'm saying, oh, I really don't know what's going to happen here, then how can I hold? How can I confidently be in that position, not get shaken out, not go break even too early? And that's what you see happens all of the time. Traders are going break even because a short-term high was taken out, and it's like that you're trading basically supply and demand at that point. You think price shouldn't go back below that swing high when you have inefficiency right below you? It's just understanding basic narrative. All right. Second question is the second time frame, or I guess the third question. So when do we use the seconds time frame and when do we not? So if you look back on, I believe, my Tuesday trade, I went down to a 15-second chart. And if you go to a 1-minute chart, it kind of just looks like price is consolidating, and it is. But when you're inside of a consolidation, if you just move down time frames, you're eventually going to find your trading model. And so that's one of the times where I'm going to elect to use a lower time frame chart, like a second chart, a 15-second, a 5-second. Rarely I'll do a 30-second, but you might as well use a 15 or a 1-minute at that point. It just depends on the narrative. And looking at that 15-second chart, if you can really see what that turtle soup was, it's the order pairing occurring inside of a 15-second market maker buy model. So if I need to find a setup, I can make a framework for a market maker model on that lower time frame. Or if what I need to do is, or let's say the condition is not consolidation and we're in a very fast run when open just rallies away. When we're times that we're going to do that, maybe it's into 50% of the opening range gap, or if we're trading into a high time frame PD array and 930 just goes. That's a time where I'm going to say, okay, well, let me go into the lower time frame chart, like a seconds chart, and catch that run on a seconds time frame. But anything kind of outside of that, I'm really not focused on. Like if we're 11:30, if we're 10:30ish around those times, and we're already created the smart money reversal, and we're just leaving a first stage distribution of a market maker sell model, then I'm probably going to look for, okay, do we have a retracement back into a 3 minute to set up a Cairo? And then if we get the 3 minute and the 1 minute doesn't form a fair value gap, that's when I'm going to say, okay, well, there's no 1 minute. Do we have a 30 second? Do we have a 15 second? Where can I enter for an inversion inside of there? Or I can just use an order block to make it simple. So those are the times where I'm going to say, okay, the framework for this is setting up perfectly to move lower. Then I can use a second chart. But that's the same with every trade. Every single thing and every single rule you have is completely irrelevant if it's not the correct time and if it's not the correct draw. So you need to have those two things before you can even consider doing anything else. So next up, we have, where do you see yourself in 3 years? And obviously, if everything goes bad, I will always have trading. So it really makes my goals super, super easy to aim for. And the reason why you need goals is because if you're not aiming at something, you're not going to hit anything. And having something that you're constantly aiming for is going to keep you on the right track. It's going to keep you disciplined. It's going to keep you wanting to do better every day. If you struggle getting out of bed in the morning, if you don't know what you're doing, if you're constantly doubting yourself, you're not aiming for something. What are you trying to get out of your life? That's the first thing that everyone needs to identify. But for me personally, that's running my own hedge fund, managing money, trading with large amounts, finance. That's what I love. That's what I want to continue doing, and that's what I am going to continue doing. And then the next is, what did my journey to profitability look like? And it looked like everything. It looked like learning Thomas Bulkowski's charting patterns, Alexander Edler, Elliott waves, GAN, MACD, RSI, EMAs, VWAP, everything. Never did Bollinger Bands. I always thought those were stupid. Level 2 in time and sales. And that journey for me to profitability, because I was trading level 2, supply and demand, and time and sales, that was the basis for Cairo. Why every time I sold below that short-term low was I getting stopped out? Why every time I longed above those short-term highs, I would just get stopped out? And when I was able to identify, okay, well, we're trading into the higher time frame PD array, this is happening, this is happening, this is happening, it's like, just fix everything inside of my trading. That's why everyone needs their own personal trading model, because you're not going to have that same personal experience and confidence inside of that model that I have, because I built that after losing a lot of money and wasting a lot of time. That's personal to me, and no one else is going to be able to have that same confidence inside of it. But after those 4 long years of failing and not really succeeding at anything, what I had to do was I had to admit to myself that I wasn't where I wanted to be, and that I didn't know as much as I tried to convince myself that I did know. So I had to go back to tape reading, and I had to back test, and then I had to demo trade for months, and then I finally, after consistently profitable inside of a demo account, then could I move to live trading. But there's no rushing that process. You can't rush into trading. It's just, you're going to lose money. You don't know what you're doing. You're ill prepared to face the adversities that the market face is going to bring you. And you don't even know yourself well enough to know how you're going to react, what makes you as an individual tick. Why are you going to do the things that you're going to do? That has to come from following a very specific set of rules, not just demo trading 10,000 contracts. It's funny to look at all that money, but following a very specific set of rules, bringing the account into drawdown, working its way out of drawdown, and doing that over and over and over again on low leverage. And then we have, what is narrative and what is order flow? And narrative is going to be the why. What is happening inside of the chart? why is it happening, and what is the framework behind why you're confident to take that trade. Price comes down, it takes out liquidity, smart money pairs their orders, then we start moving higher. Basic 2022 model. That's going to be the narrative. Order flow, I'm looking at the order flow as what's being respected and what's not being respected. Now, the order flow traders are going to hate that I said that about order flow because they view it as time in sales, level 2, the flows that are coming into what contracts, and all of that mumbo jumbo. But the way I'm viewing order flow is what arrays are being respected, where is it being respected at, and at what time? What are the octants inside of that array that are getting traded to, and what ones aren't getting traded to? Both of those put together gives you the confidence, gives you the story, gives you the outline. What are the bodies doing? What are the wicks doing? All of those things that are happening within the open, high, low, and the close at a specific time is what's going to give you the framework to enter the trade. That's what separates your trade from a pattern trade to an actual good trade according to the chart that has a narrative, that has order flow and everything behind it. And if you're going into a trade without those things, then you're pattern trading and you're never going to be successful.